Okay, everybody, welcome to another Trade Fat interview. I'm your host, Horst. I'm really excited today to welcome Markets for Mayhem, one of my favorite Twitter accounts, username at Mayhem for Markets, but we're going to call him Mayhem. Mayhem, welcome to the show, man.
Hey, Horst, thanks for having me. Really excited to link up with you and talk shop and really just I feel honored and humbled to be invited on, my friend.
Oh, I'm really excited to have you. You're one of those unique accounts that's really kind of caught my attention over the course of the last year. There's obviously FinTwit's a broad place with a lot of great information, but every now and again you see somebody show up posting really good stuff, and you caught my attention. Like, well, this guy's good. He knows his stuff. And you have interesting insight to the market. So I started following you, and I've really enjoyed your content ever since. And then I sort of just watched your account explode, right? Really take off, and you're a prolific content provider, and I think a true asset to the FinTwit community. A lot of the stuff that you share is very, very insightful and useful for myself, and I know for other folks trading as well. So I'm excited to have you. Thank you for being here. And one of the reasons why I'm excited is I know most of most of my interviews have been with traders, and I think a lot of times people forget that some of the accounts that do a lot of market commentating like you do are also prolific traders. And what I want to do today is kind of change gears a little bit from your normal, I guess, persona. Tweets a lot about markets and macro. Today, I wanted to spend some time getting in more to the nuts and bolts of how you actually trade. Are you good with that?
Yeah, absolutely. I'd love to talk more about that.
Awesome. Well, I'm excited. Before we jump into your strategy, though, let's do the background here. Where how long have you been in this game? What's your background? Tell us a little bit about you personally.
Sure, and thanks for the opportunity. And so for me, my story goes back a little ways. I actually started learning about markets way back in the 90s. It was a time where there was so much going on. I was very interested in technology, and I was interested in the intersection between technology and finance. But I wasn't, I don't want to date myself too much, but I wasn't very old at that point too. I certainly wasn't at the point where I could be a full-time trader or anything like that. So, in the
Right.
90s, I asked my dad to let me borrow some funds to buy some Amazon and some Yahoo. And it was during that time where these things were like doubling by the next day, and literally by the next day, wouldn't you know it, they had pretty much doubled. I said, okay, Dad, that's enough. Take it out. This is weird. It doesn't feel right. And that was my first trade. It was just like seeing exuberance, seeing the effect of psychology on price discovery firsthand. Very young mind, very malleable, kind of immersing myself in finance. And that experience carried me forward to the point where I watched also the other side of it. We had the greed turn into fear, and we had the dot-com bust, and the NASDAQ dropped over 80%. And so, that was also a wake-up call as well to say, okay, these things can go either way, and they can go quite violently either way. So I kind of took that note, I put it in my back pocket. I was very interested in stocks, so I kept following stocks, but I wasn't doing as much active investment or trading, just trying to kind of cut my teeth and learn. And it wasn't until about 2005 that I really started to trade and invest a lot more on my own. And that's when I really started to learn both about technical analysis and macro, and also started to learn more about the psychology behind trading and sentiment and how that affects price discovery. And so, I started up my first trading account. I self-funded it. I started trading things that I was interested in: S&P futures, NASDAQ futures, gold, crude oil, natural gas, which at the time was extremely weather-driven. So it was really fun because I was also interested in meteorology, and really just tried to learn more about how each one of these assets had a different personality. The people that were behind a lot of the trading and the algorithms that were behind a lot of the trading gave them each their own kind of unique ways of shaping how they discover price. And that was one thing that really interested me, that you could totally know how to trade the S&P, and then you could go in the gold market. It trades completely differently, both in terms of how it reacts to technicals and news and so on. And I just found that so interesting.
That is fascinating. So you're for your first, putting your feet in the water in the markets is, it sounds like the height of the .com bubble, and then your second foray on your own is right before the great financial crisis. So tell us the rest of the story. Did you trade? You started in 2005, then on your own with your own account. Did you trade right through the GFC and still to this day?
Yes, and you know what? I know I have a little bit of a nuanced view on this. I found the Great Financial Crisis to be both the most exciting and terrifying time I've ever traded.
Hmm.
Exciting because the price movements were absolutely off the charts. I mean, if you look at the 2008 financial crisis, and we'll dive into that a little later, but if you look at the way that prices were moving up and down, that kind of volatility was really exciting for me as a young trader with a higher risk appetite. It was also
Hmm.
very interesting to see which parts of the market were really weakening. You have rotations into sectors. You also have rather violent rotations out of sectors. And in this situation, a lot of those more vulnerable financials that were highly leveraged with mortgage-backed securities, they were under the gun. And I mean, some of these things completely died. Bear Stearns, Lehman Brothers, Countrywide, et cetera. I mean, it had its merger, but it really did kind of die before it went to Bank of America. And so that was really also a place where I started to learn that, even though at the S&P top level, things kind of trade in this sort of containerized index, that underneath the surface, you could have immense amounts of violence that you don't see in the index. So it really started to teach me more about appreciating what was going on at a sector and individual stock level. And I also started to cut my teeth learning a little bit more about how volatility affects the market, because every day on the news they're talking about the volatility index is hitting a new high, and everyone
Yeah.
should be very frightened right now. And really what I learned from that was actually it just means that price ranges are going to be larger. And so you're going to have, probably wanting to put on smaller position sizes and be a little bit more careful as volatility is ratcheting higher. But for me, the great financial crisis was also terrifying because you'd wake up and I swear I'd wake up at 6 or 7 a.m. Eastern, I'd turn on my terminal and the Dow would be down, limit down. And you're like, oh my God, what is even happening right now? Like the whole world is just melting before my very eyes. You'd have moments where there was almost no bid on a company like Exxon, which at the time was one of the biggest companies in the world, and just free falling on some of these days. So it was exciting because it was a great place to learn about what a bear market really looks like. And this is one of the most vicious bear markets I've ever seen. But it was also frightening because you saw how quickly the floor could just disappear from out under you if you were long, and also how quickly you could have your face ripped off as a short in these counter trend rallies.
That's fast. I mean, what a fascinating way to start trading, though, right? Just getting your feet underneath you right before all that shit hit the fan. I can't that. Just the experience that you brought from that, I imagine, has probably stuck with you and shaped how you trade today. Which is kind of what I want to pivot into a little bit. One of the questions I've been asking everybody, just so we get to know you a little bit more, what is your bread and butter? Or I've been calling it your desert island instrument. If you could only trade one thing, stock, a future, crypto, what is it?
I think for me, if I could only trade one thing, it would be the S&P 500 futures, because it's really liquid. I understand its personality pretty well. I've become familiar with some of the drivers for price discovery. And for me, it's also one of those instruments that, I can put on a chart and I can really just get a sense as to where we are very quickly, because I've been trading the S&P probably more actively than anything else. So that's got to be my hands down favorite.
I love hearing that, because now we have something in common and we connect with, because I'm an S&P man as well. But just to expand a little bit more, what else are you trading today? So that's your bread and butter. But, a lot of times folks dabble in other markets. What are your go-to? Do you have go-to trades today? Are you primarily S&P, or are you pretty spread out between individual names and, commodities? What's your full basket of things you trade right now?
So that's a great question, and it encompasses a number of different asset classes. I trade individual stocks, I trade options, I trade futures, equity futures, commodity futures, bond futures, volatility futures. I used to trade currency, but honestly, it's gotten a little boring these days with central banks kind of controlling all of it and macro having very little to do with it. It really kind of depends on where I see opportunity. I have been working more and more on back testing a systematic approach to look at some of the signals that are more reliable to get in and out of some of these things on longer term swings. But I also like doing shorter time horizon trades, on an hour by hour basis or even a day to day basis in things like the S&P or in the Russell 2000. The NASDAQ. Not a really big fan of the Dow futures. Sometimes it trades kind of like a penny stock, in my opinion. I like trading I like trading the sovereign duration. Treasury futures have started to trade more like growth stocks, and you can see the move index is over 80. So we've got a lot of volatility in Treasury. It's been kind of fun to trade those lately. And I also like to trade things like gold, silver, oil. I don't trade natural gas as much as I used to, but I trade it sometimes. But I don't do these things like the S&P is like my stalwart. I go to that almost every day if I'm trading. Some of these other things, I look for a very defined risk reward opportunity where I feel risk is very low and reward is outsized. An example of that with oil was when OPEC Plus was meeting, I want to say it was in November, that we had this rout in oil. It went down to the high 60s, and I felt, based on macro, based on fundamentals, and based on technicals, that the move was overblown. And so I took a pretty sizable long swing there, and I had a nice stop below there where I felt like if it went below this level, we'll probably see a lot more sellers come in. And my kind of thesis was, the psychology of the market is so beaten up from Omicron. Everyone's assuming this is going to be the end of the world. In the meantime, the energy stocks themselves are calling the bluff of what's happening in the commodity. The energy stocks didn't get routed the same way. So I said, in my thesis, I think oil catches up. And of course, I could have been wrong. But in this case, I wasn't. I had my risk also clearly defined. So, if I lost more than like 2.5% of the position, I was out flat. But it worked out pretty well. And I rode it up to the mid 70s and I closed the position and I look for the next opportunity. And those are some of the things that I like to do that are more sort of opportunistic. I don't trade oil every day. I know some very good traders in the oil industry. They trade it pretty much every day and they kill it. For me, it's more like, oh, this looks like a great setup. I'll give that a shot.
So mayhem for markets is really a man for all markets, right? I like that. So you trade a lot of different stuff. I think that's going to give us a lot to talk about. And one of the reasons I reached out to you is that you do trade and post about a specific style that is foreign to me. And as a curious person, I wanted to learn more about how you trade and one of your go-to strategies. So I was hoping you could walk us through and give us some background to help us understand, what setups excite you the most. That's what I'm always interested in asking other traders. Like, what is the setup you look for that just makes you salivate? So we're going to turn to the charts here in a second, but also helping myself and our listeners understand with your go-to strategy, how do you determine when you're wrong in a trade? How do you determine when to take profits? Position sizing. These are the questions I've been asking most of the folks that have been on the show so far, because I think they apply to all of us as traders. We can learn from that. So if you're good with it, should we go to the charts and maybe walk us through your style a little bit?
Yeah, go ahead and hit the chart. And while you do that, I'll answer some of those questions because those are great questions. And I think they're really important for everyone of all skill levels to continue to evaluate for their own trading style. So for me, I try to have, before I get into any trade, my risk and my reward or potential reward kind of qualified, especially my risk. I always try to focus on risk first. And if it exceeds that threshold, which is for me, it's somewhere between 2 and 5%, right? I don't want to get much below that unless it's a very small position. So in terms of position sizing, I size positions based on what I think the volatility of that instrument is. If something's more volatile, like if I was, trading a little bit of crypto, I'm using very small position sizes because not only is it volatile, but the spreads sometimes get pretty wide when that volatility picks up. So I want to be able to get out without too much slippage, right, or too much loss. On the other side of it was something like SPOOs, or S&P futures, where they're at least usually less volatile and quite a bit more liquid. I can get a little bit more bold on my position sizing because I feel like I understand it more, and also because I feel like it's not going to rip 10% randomly, right? Like you can see that in some of these other things, and it could just rip your face off if you're betting the wrong way against it. And so my whole risk reward management system is really about having that defined before I get in, because if something goes against you when you're in the trade, as you well know and other experienced traders well know, it's just a lot harder to come up with managing that trade on the fly. You want to know what you're doing before you get in. So that's really an important baseline for me.
All right. So what we have on the screen here now, we're looking at one of your charts, and I want to introduce this because I'm familiar with Ichimoku, but it's not a strategy that I trade. So I did contact you to say, hey, Mayhem, walk me through how you use this, because I know this is a style that many use, but it's something that's not exactly in my toolbox. So start from the top. Like, tell us about this particular strategy. What is on the chart? What's useful to you? Stuff like that, I think, would be really beneficial for all of us.
Sure, absolutely. And I appreciate the opportunity. And I know this is something that folks are interested in. I get a lot of questions about it because it's a little bit sort of unconventional in some senses. So Ichimoku Cloud, this style of technical analysis is almost 60 years old. It's about a little over a half century old. It was invented by Goichi Hosada. He's a Japanese journalist, and he basically created this whole system to have more information than just a standard candlestick chart. And I know the charts look busy. That's sometimes one of the bits of feedback I get from folks is, oh, well, there's so much on that chart to look at, I don't know where to start. So I want to break it down a little bit. So can you see my mouse cursor on the screen?
Yep.
Okay, perfect. So we're looking at a monthly time frame here on the S&P 500 cash index, and we're just looking at trades that happen during regular trading hours. These indicators can look different if you're looking at, say, the trading that happens overnight in pre-market. And we're looking at this going all the way back to 2001. So we can actually see two bear markets in this chart, which is pretty interesting. So, first, the thing that I like to talk about is we have the indicators called the Tenkan Sen. That's this blue line. That's the conversion line. That's what that means. You have the Kijun Sen. That's this sort of brown line here. That's the baseline. These are, if you want to kind of equivocate them to things that we're more familiar with on a technical basis, you can kind of look at them like moving averages. They're not the same as moving averages insofar as how they're calculated. And we're going to have a link in this interview so everyone can get some more information about Ichimoku. So, we won't break into all the math here. You can read about that later. But basically, they act the same way in the sense that you look at them as support and resistance levels. You look at crossovers one way or the other as indicators. And so we can see, and one of the things I like to do with any technical analysis strategy is have a sense of price interactivity. The more price interactivity I have with any kind of indicator that's an overlay on the chart, the more confident I am that that indicator has validity, right? And so you can see a lot of price interaction with these indicators. For example, during the downtrend that we had in 2001 through 2003, you could see that for most of the time, the S&P 500 was below that conversion line, the Tenkan Sen, and that's pretty bearish. It kept having these counter trend rallies. It would rally into the Tenkan, and sometimes it would break above, but most of the time it would fail, and inevitably it always failed until it finally based. So why is that important? Because if you're looking at this chart and you're trying to get an idea of trend, one of the indicators you want to look at is that Tenkan. The other one you want to look at, which is the base, is the Kijun. You can see it was a similar story, and the market never broke above that Kijun until it finally bottomed and began to make that move that kind of ushered in the new bull market that started. So the Kijun is this blue line. The Tenkan is the brown line. You really like to see the Tenkan cross above the Kijun. That's a bullish crossover, sort of like when you have a 20 crossover of 50. You have that indication that momentum's coming back in the market. So that's kind of your initial sign. Like when you saw that this was bottoming post.com crash, first you saw kind of a W kind of pattern, kind of a little bit of a W double bottom. So for just basic technical analysis, you see that's encouraging. You see a break on a monthly candle above that Tenkan. So that's another confirming indicator that, perhaps we're starting to put a bottom in. You see a break above that midpoint, and then you see a break above the Kijun, and finally the Tenkan cross above the Kijun. So you've got a very healthy reversal in progress, but we don't qualify as being in an uptrend until we've crossed above the cloud. Now that's important, and we're going to talk a little bit about what the cloud is. You have the Senko A. That's the leading span A. That's this green part on the top of the cloud, and you have the Senko B. That's the leading span B. That's the red part on the bottom of the cloud. Now you can see here we had a
So,
bearish
so
cloud
just
twist.
real
Yep.
quick, it looks like there's some weighted volume bars on top of that. I
Yes.
don't know if everyone can clearly see. Yeah, let's use the clouds over on the right, maybe if you can
Here,
walk
I'll
us
take that
through.
off for now. I'll just
Okay,
kill that for
cool. Yeah,
now.
that's good. It cleans it up a little so we can see what you're talking about.
And this is really important. So this is a cloud twist. So the cloud, what it represents in Ichimoku analysis is two different things. The first is the health of the trend and what kind of trend you're in. So when you're above the cloud, this method of technical analysis, obviously depending on your time frame, indicates that you're in an uptrend. When you're within the cloud, it indicates that your trend has been neutralized. And when you're below the cloud, that is a downtrend. And so you can see, per Ichimoku analysis on a monthly time frame, you were not really in a healthy uptrend until just about 2005. And that's when you broke above the cloud, you honored the Tenkin, and you were continuing to move higher from there. But you also had a little bit of a warning side with this bearish cloud twist that, be careful, because, you could see some potential volatility come back in. And of course, it took a little while, but it did come back in. And when we had the great financial crisis happen, your first clue was, we had a bit of a double top here, which actually kind of correlated with a top that we had in 1999. Like, that was the fact that it couldn't really meaningfully break above there on a closing basis and hold it was a very ominous sign. Right. So that's a pretty textbook double top. But you also had these crosses below the Tenkin, the Kijin, and the cloud, as well as the Chikou. This is also one other area we're going to cover. This is a lagging indicator, this gray line. And so when the gray line is above price, that's bullish for trend. When the gray line is below price, that's bearish for trend. So, what you're looking for in Ichimoku, as is the case with a lot of other schools of technical analysis, is convergence, signals that give you a confluence of different indicators that give you confidence about which way price might be heading. So once again, we had the kind of reversal of what we had on the upside here. We had the break below the Tenkin, the Kijin, and we had a break into the cloud. And so a lot of these indicators are telling you very strongly that this was ominous. Like up here, and you see the Tenkin crossing below the Kijin as well, and that was actually what helped to set off some of this selling on a technical basis. That was a very ominous sign. So the double top, the bearish cross, the cross through the cloud, that all told us that on a monthly time frame, and these monthly time frames are very important to watch, that this market was in serious trouble. And we did have a V-shaped bottom. That was kind of unusual, but policy kind of defined price discovery in March of 2009. And so you can see the cloud also can act as support and resistance. There's a lot of times where the cloud top and bottom act as levels that you want to watch, because sometimes the market consolidates there, and you can kind of look at the cloud and say, this is kind of a visual representation of positioning of market participants. Kind of gives you that sense as well. So when you bounce off that cloud top, that's bullish. That's really solidifying that, hey, we're maintaining this uptrend despite having this bearish cloud twist here that gave you this warning sign that perhaps something like this would be coming. We actually held that, rallied above the Cajun, rallied above the Tenkin, and continued that uptrend all the way, basically until 2020. And we had that COVID scare, and we only broke into the cloud and became trendless for one monthly candle. And that was an extremely powerful rebound.
So what you're showing here, I mean, this is super applicable if you're an investor, swing trader, but I know you do a lot of day trading. So how well do these principles hold for intraday traders, swing traders? Let's see if we can modify the chart, because I'm looking at like where you bounce off that red cloud. If people are trading the way they're trading right now, they are dead broke at that point, looking for a job at Arby's somewhere, right? So like by the time that candle bounced, they've blown up their account. So let's see, how do you translate this to day traders and people that might be trading at a shorter time frame? Do the principles still hold? And then maybe get into the math a little bit, because I'm curious, what are the inputs here? I don't think this is volume based, but I want to understand from you, what makes the cloud?
Sure. So let's zoom in just a little bit. We'll go to weekly, daily, and then we'll go to some intraday timeframes. So weekly, you get more indicators like more rapidly, right? So you could see how some of these things look a little bit different on a weekly basis than they did on a monthly basis. And I think that's pretty important because, if you're trading shorter time frames, you're going to want to continue to zoom in on charts to see what's applicable to you. But you can also see, again, even in this time frame, there's so much interaction with all these key indicators. There's so much interaction with the cloud, the Tenkan, the Kijun, the Chikou. And so, even on a weekly basis, you could see, for example, with this trend that we've had since the COVID rout, which brought us into a very short time horizon downtrend on a weekly time frame, that velocity of price brought, all that liquidity from central banks really brought us right back into an uptrend not many weeks later than we carved out that bottom. And since then, we have not touched the cloud again. You'll notice that after the early part of 2020, we have been in a very healthy uptrend. And even with some of the noise that we've seen, the sell-offs that we've seen, we have not broken below the Kijun once.
Not only have we have not even come close to touching the ground, let alone the cloud, which is hilarious. This
exactly.
One hell of a bull market we've seen here.
So if we then zoom in further and we look at the daily time frame, this is where you start to see some actionable signals for swings, right? If you're trading intraday, you're going to want to zoom in to maybe an hour or a half hour or 15. But for the swing trades, I really like the daily time frame because it gives me a lot of constructive and actionable information. And you can see, and we'll zoom out just a little bit here just to get to see the COVID crash here. You could see on that daily time frame before that COVID crash, you had some pretty good warnings here, right? Let's just look at that. You had, across below the Tenkan, this gap down that followed, cross below the Kijun, cross through the cloud. So right here, you had a convergence of sell signals that said, something doesn't look good here. It's probably time to get out. You also had this early warning from the Chikou crossing below price saying the trend is not healthy here. Be careful.
So help me understand that, because if I'm looking at like current price on the chart right now, the gray line, I'm sorry, my Japanese isn't really good yet. I'm still learning these words here, but that's lagging. It literally looks like copy paste of price action and you just pulled it backwards, and it's not printing now. So how would you have seen that? Is that more of a hindsight thing? I'm trying to understand the value that the gray line provides.
Sure. So, there is a little bit of validation through hindsight. Absolutely. It is a mirror of price. And basically, it's just a mirror of trend health. It's basically saying, look, if price is here and you're below where you were before, that doesn't sound like an uptrend. But on the other hand, if price is, like where it was here or where it is for most of this bull trend, as long as the Chikou is remaining above the price of the asset in question, that's telling you you're in an uptrend. So it's just another corollary indicator to add to the basket for confirmation. So,
okay, so you are looking at it like right now. Like, how would you assess that right now?
Right now, I'd say we're still in an uptrend, but it's a little bit iffy, and we had a test of that here just based on the Chikou. And now we're still up above it over here.
Gotcha.
So if you kind of think about it, what you're looking at is that the trend is still progressing higher, that the price that it experienced previously, that it's still kind of making its way above that. So that's how I use it. And you look at the Chikou crosses between it going above price, indicating a healthy uptrend, or below price, sending a warning sign about that trend's health.
Gotcha. But by the time, that's what I'm trying to understand is like by the time the warning sign would print, it's already extremely lagging, right?
To an extent, like for right now, it's still valid. Like right now, you've got an uptrend that's valid. We haven't had the line cross below. I mean, if today that line crossed below price back here, that's still a concern. So even though it appears to be lagging, you could see that it is just basically, like you said, it's kind of mirroring the current price action. So it's basically telling us, look, if current price action is crossing below prior price action, that's a concern by that lagging indicator.
I see. Now, is that an adjustable lag that you have on there? So how do folks set that? Or is it like kind of a standard Ichimoku setting or input?
That's a great question. You asked about the math. Everything is standardized. You can, of course, customize it. And if backtesting, one finds that different input actually improves results, then absolutely one can adjust it. Personally, I tend to keep it pretty vanilla across all assets. It helps me to have more consistency in terms of how these things apply. But I do know other people that are using more systematic approaches with Ichimoku may adjust those inputs. And it like you asked, is volume an input? No, it's really price and time. Price and time are the two big inputs for Ichimoku. That's really where all the data is coming from.
Okay. Interesting. Yeah, I'm really intrigued by the cloud bounces here on the daily time frame. I feel like that's there's obviously something here noteworthy. Be interesting to go back and do some back testing and look at it. But what about intraday? So I'm assuming for your prep, you start by looking at a daily, I'm assuming like this, right? To understand the current trend, and then while you're trading in the day, are you using this same strategy?
Yes, and so I use a very similar strategy. I do have, and I'll add this back in here. I do have volume by price on when I'm trading during the day. I like to have that. I use a slightly different charting system than what I'm showing you all. This is usually what I use for my longer term charts that I share online. But
Mm-hmm.
nevertheless, it's still the same nuts and bolts. So, you could see that volume by price is a pretty important indicator. You could see it actually had some interplay with this key level here where we had a bounce. But this is a 60-minute time frame. So we're using all the same indicators, and we're adding volume by price back in just because it can kind of give us a hint as to where supply and demand may exist. And you could see that on an hourly time frame, the move that we had yesterday, especially post hawkish Fed minutes, it really took the markets quite a bit. It had a really hard drawdown that continued into the end of the day. You had a pretty bearish candle print. And what I take away from this is that we couldn't get above Tenkin. Then we couldn't hold the Kijun. Then we broke into the cloud and ultimately below the cloud, and then started to see the cloud as resistance. So that's pretty bearish price action. Like if I was in this market and I saw that the price was unable to stay above the Tenkin and the Kijun, I'd be shorting around here. As soon as you get into the cloud, you become trendless. And then I'd be looking for the potential to take off shorts at the bottom of the cloud if we see any support. And so that's how I would handle that kind of trade on a 60-minute time frame. And if you zoom in, you can kind of see pretty clearly the Tenkin's crossing below the Kijun. You have a sort of counter trend candle attempt, and then a massive failure. And so that also, because I'm looking at candles too, no doubt I'm looking at the formations, the patterns that play out as well. So Ichimoku is just one of the tools that I'm using, but I like it because it gives me additional confirming kind of technical indicators to, give me the confidence that I want to have to see what's happening in the trade with maths that I really can't do in my head in real time.
Okay, so quick question on the cloud formation here. I know there's some math involved, and we'll provide links for folks who are interested in diving into the math a little bit. I was curious, since we're looking at SBX, is the gaps from the opens and closes with SBX, since it doesn't have the overnight in here, is that affecting like the jaggedness of the cloud? Like because you said you like trading S&P just like I do. Are you primarily looking at SBX, or are you using this as well on ES or SPY, for example?
That is an excellent question. And it's one where I've had a lot of discussions with other traders that use Ichimoku, and there's thoughts that go both ways. Personally, I do use ES, and I use with ES the overnight data. So for those out there that are in home gamer land, that is the S&P futures mini contract. And the reason that I use that overnight data and that pre-market data is it does make a difference with the indicators, especially on more granular time frames, like your 60-minute and your 30-minute and your 15-minute and even your 2 and 4 hour. It's a little bit less impactful on the daily time frame, but it still matters. So yes, absolutely, that's a great question, and I do endeavor to use the ES contract because you do have a lot of price action that happens overnight that still matters, and you need to kind of factor it into the math if you're trading intraday.
Absolutely. Okay, that's really interesting. That's good to know. So what is your go-to time frame then, candle-wise? Is it the 60-minute chart here, or are you more granular than that?
So time frame kind of depends on volatility a little bit to me, and I know that's not like a straightforward answer. But on a day like today, where it's a slower kind of day, I'm more inclined to use a 15 or 20-minute time frame on the candles. And on a more volatile day, where there's wider swings in ranges, I'm more inclined to use an hour or 2 hour time frame for intraday trading. And it just has to do with testing that I've done in the past, and then also trying to take advantage of some of the bigger indicator crosses. And there's certainly situations where I'll be watching multiple time frames during a single day. Like I might be watching a 15 and a 60 at the same time, because sometimes I'll see signals on both that converge, and that increases my confidence of the trade.
So it looks like you also have some sort of stochastic oscillator on the screen. Tell us a little bit about that, and does that play a role into your decision making?
Sure, that's a great question. I like to have convergent signals wherever I can, and oscillators like the full stochastics that we have here gives me another one that just gives me signals about bullish and bearish momentum that helps to increase the confidence if I see similar signals from Ichimoku. Like if I see, support being provided by volume by price and the Tenkin, and then a bullish momentum signal, just as an example, that gives me more confidence that perhaps that's a good trade, and I can get long, and then I can see if any of those signals break down that maybe it's time to exit that trade. So I like having stochastics on there, especially for time frames where I'm looking at a trade that's either a reversal or a breakout for the continuation of that momentum, right? And so the main thing that I'm trying to do, I'm mostly using Ichimoku and candlestick patterns, but I also kind of defer to volume by price and full stochastics just to get an extra boost, right? So those I would consider Ichimoku my primary, and candlestick patterns my primary sort of basic technical analysis, and then the stochastics and the volume by shelf sort of secondary and tertiary indicators.
Gotcha. So what would be your go-to? I've asked this question to everybody. I'm curious for you, like maybe not go-to, but what setup excites you the most? Like when you see a trade setup here, what's the one that just gets you excited? Like, I know this is a high probability trade based on past experience, and I'm ready and anxious to take it. Do you have one that gets you excited?
Breakouts and reversals both really excite me because that's really where you get a lot of momentum, and even the other side of that, like breakdowns, so you have breakouts out of price ranges, breakdowns through price ranges, and then reversals where something's bottoming and coming up or topping and coming down. Those are the kind of trades that I really like, because for me, it's very easy for me to quantify my risk and reward, to track whether the technical thesis is still valid, and therefore I can go through that trade with some sense of confidence. It's much harder for me to trade without being able to quantify that risk and reward, both in terms of the prices that I'm expecting, but also in terms of the technicals I see on my screen. So I really like to wait and kind of snipe. I really like to look for trades where I feel like, I've got minimal risk, I've got better reward, and for me, I have a better track record with those reversals, breakouts, and breakdowns.
Same, exactly. Yeah, I couldn't agree more with that. I think we were on the same page in terms of preferences there. So help me understand. A related question then would be, and a question I get a lot too, is when do you take profits using this method? So say on the chart, if you have a better example, that's fine. I'm just looking at the chart we're looking at right now. If you got long that breakout above that cloud early on the left side of the chart, and you are just living the dream over there, what's your method for saying, okay, I think, I'm going to take a core position off, or I'm going to, take the full trade off? How do you determine when to take profits?
Sure. And I just want to take volume by price off there just to make it a little bit more clear what we're looking at here. So, what Horst is talking about, we got this uptrend. It crossed through the cloud. We had it cross through the Tenkin, the Kijin. The Tenkin crossed above the Kijin. You got kind of everything you wanted to see except for that bearish cloud twist. So the first thing I'd say is, we've got a bearish cloud twist. Let's watch price action as that's going on. So we're moving up, we're moving up, we're moving up. We see one problem happening here, in addition to the bearish cloud twist, is that we're now seeing the Chikou is actually below price. So that's another kind of potential warning. And then finally, we see that price is now crossing below the Tenkin. So I'd be taking profits around here, because 3 strikes, you're out. You really can't see multiple indicators that were telling you to be bullish, go bearish, or at least questionable, and still hold that trade. So if I was getting into that trade with the Tenkin cross here, I was getting out of that trade with the Tenkin cross here. Bullish cross, bearish cross.
Okay, so that's your primary method. That makes a little bit more. Okay, so what about stop losses? Let's talk about the reverse in terms of managing risk, position size, not necessarily just using Ichimoku, but how do you approach that as a trader, considering you do trade in many different markets, in different time frames? How do you manage risk?
Yeah, that's a great question. So the first thing I do is with position sizing, I try to correlate that to the volatility of the asset. And then the stop that the loss that I'm willing to take is related to that as well. I typically don't like to go over a 5% loss, but with some things, if you're trading like crypto and you're doing swings, you gotta be able to stomach a little more than that, or you're going to get stopped out prematurely. But for other things like my mainstay, like S&P, I'm not looking at a stop loss usually more than 0.25%, 0.5%, if I'm doing an intraday trade. And then then once I get into the money, I'll usually set a trailing stop and I'll follow the trade. And if it crosses below the tank, and I'll just take my profit off anyway, right there. But I like to try to be very nimble. So, I'm looking for opportunities to get in where I see a reversal. And as soon as I see that it's running out of steam, or as soon as I see a breakout or breakdown running out of steam, and that's usually quantified by, like we just talked about with this chart on a breakout, you see this cross below the tank, and I'm getting out there as well. So from a risk management perspective, I'm fluid. I try to, as Jem Karsana said, be like water. I like to try to be like water on my trades. And so I'm usually, if anything I have open that's not a longer term swing, I'm watching it very closely. And even though I have a stop in place, whether it's the original stop or the trailing once I get into the money, I'm also watching for that technical signal, and I will get out based on that signal.
Interesting. Okay. So what about position sizing? So I know everyone's different. You put full size on first, peel off as you go? Are you somebody that likes to pyramid and add? What about that?
That's a great question. It depends on what I'm trading, but often is the case I like to scale in and out. But there are some situations where I'll go, all in, and I'll go all out if it's something that I'm trading that's not a large position size. So for larger position sizes, I really like to try to manage my risk and reward by scaling into that position. And I like to scale in. I don't like to average down, right? So I really like to average up. If I have something like this kind of a trade that we're looking at on the screen, I'd be putting on my initial position here. Then we cross above the Kijun. I'm more confident. I'm adding to that position. We cross above the cloud. I'm more confident. I'm adding to that position. Then I'm letting it run until it tells me to get out. Right. And so then I'm taking off pretty much the whole position at this point. Now, other times I might scale out if it's really a longer runner and I just see it crossing up above levels and, getting to a point where it's reaching my price target. Some of these things I have price targets that are based on previous technical levels. Like if I was playing this swing here, and I saw it crossing this level, I would take some off at this level, and then I would be taking off the rest after it crossed through here. So if I was getting in here, I was taking off probably half of it here, and then the rest at that bearish cross. So, it doesn't always work on every trade in the sense that you're not going to, make goo gobs of money on every trade, but it does help to manage your risk and your reward. And so you have these indicators that allow you to be much more systematic in your approach. Thus, you take the emotion and the ego out. It's not a matter of right or wrong. It's a matter as to whether price is working in your favor or not.
Nice. Yeah, absolutely agree. Let me pick your brain a little bit about trading sort of as a whole, as an art or as a passion. You're very active on social media, and I know you like one of the things that really struck me with you is that you seem to also be interested in helping others learn about markets, learn about trading. I have huge respect for that. What do you think, based on your experience, what's one thing all retail traders should start doing right now to improve their trading?
I think the biggest thing that every trader needs to do is to be patient, to be disciplined, to have a mindset that really corresponds with the risk that they're comfortable with taking on. I know a lot of people get into too big of position sizes and kind of blow up their account. I think it behooves us as traders to remove ego. I know it's hard. No one can do it 100%, but the less ego and emotion we have about being right or wrong, the more consistent we can be with our trading. And I think it's very important that when we do well, we don't treat ourselves any better than when we do bad. And what I mean by that is don't let your P&L define your well-being. If you're killing it or if you're getting killed, you need to still be objective, because if you're killing it and you get all set, you get all hyped up, you're going to probably be less cognizant of risk management. And if you're getting killed and you're letting that beat you up, you might not be willing to take on the kind of risk you need to reverse that outcome. So it really sometimes, in my mind, is all about that discipline. I really think it comes down to that. And I know for newer traders, it takes time to figure out what it is exactly that works for you as a trader. How do you manage risk? What kind of assets do you like trading? So, I'm just imbuing my experience to try to help, but not to necessarily replace what you've learned along the way. But at the same time, I would say for every single one of us in any part of finance, this is a limitless beach of knowledge and information to accrue. And we are able to ascertain maybe a grain or two of sand on that limitless beach. There's just always more to learn. And that's a great thing. But you also have to ask yourself, are you passionate? Are you excited? Is your mind hungry for that knowledge? Because if you are, that's a very good sign that you can succeed. And then finally, I would say, a lot of retail traders don't succeed. And one of the biggest reasons I see is because they get too emotional and they're willing to give up. But often is the case that as you're getting to that point where you're willing to give up on everything, you may actually be closest to reaching some level of success. And what I mean by that is when you have those really difficult drawdowns and you say, I'm done, I'm throwing my hands in the air, whatever, that's actually a really important lesson for us all to learn about risk management. Almost every trader has blown up an account or at least had a really difficult drawdown at least once. And those are
Absolutely.
lessons. They build us as traders. That's you don't need to be ashamed of yourself or feel like you ruined your life or any of the kind of hyperbolic stuff that I hear out there. Really, you've just had an experience that shaped you as a person. You've learned that risk is more important than reward, and now you're going to be a better trader if you can appreciate that value. So that's the kind of wisdom I try to imbue. And I know that sometimes, we need to make our own mistakes, but the fact is we all pay a tuition to the market. And it's a question as to whether we're willing to learn the lessons being taught.
I love hearing you say that. Absolutely, man. That gets me pumped because I completely agree. I think there's this perception, and it's probably fueled by, where a lot of people get their trading information, which nowadays is social media and things like Twitter, where, people don't make mistakes. And I think it's absolutely ridiculous. Trading is not a game of perfect. There is a learning curve to it. Nobody comes right out of the gate amazing at it, right? I think there's a lot of great parallels for me personally between trading and golf. Golf is one of those sports that it doesn't matter who you are. The first time you pick up a club, you suck. Right. It takes grinding. It takes a lot of practice. Whereas some people, the first time they pick up a pencil or a paintbrush, they have a natural ability that is immediately evident. I don't think trading's that way. I don't think golfing's that way. It's a little bit different. These things take repetition, practice, discipline. So I really love hearing you passionately speak about that because I think it's important for people to understand that you're going to take some hits, right? And I'm sure you saw it in your experience so far trading through things like the great financial crisis, that not everyone's perfect. People make some bad calls, some bad mistakes. And so speaking of that, what do you think is the biggest mistake you see people making?
I think the biggest mistake that people make is not cutting losses and not riding winners, especially when you talk about swing trades. Because I see a lot of people who have great ideas, but they're not willing to admit they're wrong. And by not admitting they're wrong, they're carrying their losers and they're suffering both financial losses and from opportunity cost. That cost keeps rising for every moment we hold a bag and we aren't just willing to jettison it and take on the next opportunity. So I think that that's really kind of the biggest combination of problems I see. And I would say that, this is a stat from a friend I know who is a systematic trader. He's a fund manager. He's one of the best traders I know, hands down. And he gets it wrong all the time. And yet he's still able to compound anywhere between 80 and 100% a year on the low ball side. And this is a guy who I have a great deal of respect with. I've traded with him. He's helped to mentor me in the past, and he's taught me about the more systematic side of trading. Mm-hmm. And he's saying, look, I can get it wrong 60% of the time as long as I'm cutting my losses quickly enough. And on those 40% of trades, as long as I'm riding my winners, there's no reason that you can't continue to perform. So what does that mean? It means take your ego out of the equation. You can be wrong more than you're right. And as long as you manage your risk, you can still kill it.
Absolutely. That's awesome. So given your high level of activity on social media and trying to help other folks understand markets and trading, just a fun question. What is the question you get asked the most in your DMs? I'm just curious. I got to know. What are people constantly asking Markets and Mayhem?
There's the serious questions, and then there's the kind of facetious ones, or at least I look at them facetiously. I always get people asking me, what should I buy? What should I invest in? And I always try to tell those folks, like, look, I'm not an investment manager. I'm not here to guide your financial journey. You're going to be better served by making those decisions on your own, so you know why you've made them and you can quantify your risk and reward. But another question I get a lot of is, do you do any kind of mentoring? Do you do any kind of teaching? And my goal is to embark upon that journey and help more people out. I mean, I've had so many people ask, and I've had so many people encourage me that it feels like it's time to turn over a new leaf and try to offer more to people than what I had been. And the best way to do that is to do some one-on-ones and some classes and have some personal hands-on time with folks that can really show them, and also to produce content that gives them that that in a kind of written and visual form. So I've been doing more on YouTube. I've been doing more on this sort of blog I've been putting together. I've been doing more on Twitter in that sense, and then I'm going to try to do more in more sort of professional ventures that can help people with the sort of mentorship and teaching and making them better retail traders over time. So that's a great question. I'm glad you asked it.
I'm sensing a segue here, Mayhem. Are you sensing a segue?
Absolutely.
Should we tell him? I think we should
so.
tell him.
I think we should tell him.
I'm really excited to announce a formal partnership between myself and Markets for Mayhem. We are super pumped and excited to announce that TradeFat.com is now becoming TraderAid.com.
And if you all remember the classic sports drink, there's a little bit of a call out, but not so much that, we're trying to mirror them. We just want to, pay props that we're here to try to help, a journey for retail traders, by retail traders, offering that kind of mentorship, because everyone out there, in my opinion, really, if you're starting your journey, or even if you're midway through your journey as a trader, we are all better served by having a more expansive skill set, by having people who have come to this journey from different viewpoints and different backgrounds help us to fill in some of the gaps in our knowledge and our skill set. And so the more information, the more knowledge, the more mentorship we can have, the more mistakes we can avoid, and the faster we can become proficient. So our goal, working together, I saw Horst starting his website, and I have to say, from the very first moment, I was excited, because I know here's a guy who's a great trader. He's also a great mentor. He's got a lot to offer the world, and it ended up that it was so much, there's so much demand that it was too much. It was like you're a victim of your own success, and that's the best kind of problem to have, I mean, quite frankly. But Horst reached out to me, and he said, look, I've been watching you on Twitter. I think you have a lot of great stuff to contribute. Would you be interested in talking about working together on this? And from that very moment, I have to say, I was first very humbled and honored to even be considered, and also extremely excited about the possibilities that could spring forth from this endeavor.
Man, you have no idea how excited I am. I mean, I honestly, I think I probably got myself in over my head. I didn't know how much was involved with, just offering to help people learn how to trade. I wanted to start with just, this is how I trade, because I don't know any other better way to teach, right? Like, I'm not here to tell people what to do. I figured, let me share, this is what I do. This is what has worked for me. This is my system, my process. And yeah, it really turned into something that I got really excited about, just seeing people grow, seeing people's success, the emails they were sending me, the DMs. And honestly, it started to distract from my own trading, and didn't really have the time to keep up with everything. So I was really looking for a strategic partner, somebody that has that same passion that I do about helping others trade, about growing on our own journeys too, right? We're both still traders and ridiculously passionate about markets. So we wanted to create something to help everybody else feed their passion for markets. And I think one of the things that's going to make this so fun is that we kind of have a yin and yang thing going here. I think we balance each other really well, because one of the skill sets that you have that I admittedly struggle with is that really vast macro knowledge, right? I am a trader, and I trade like an idiot. I've been very clear about that to everybody, right? And I mean that in a fun way, right? I dumbify my process down to as simple as possible. I experienced so much pain early on in my trading experience trying to outsmart the market, and I realized that works if you're playing chess with somebody, but the market is a never-ending game of 3D chess, and that constant desire to outsmart it was not working for me, right? So I became a trading nerd, an execution nerd for day trading, but that had kind of left me in a bit of a vacuum, right, away from the macro sphere of just understanding what's happening at large. And sometimes I get so consumed in just the instruments that I trade and the price action, the details that I really care about, that I lose sight of what's going on in the world. which is where I think you are a master of explaining the sort of the macro landscape in a way that people easily understand, in the way that people digest and gravitate towards. Because look, honestly, a lot of this stuff is not easy to understand. Half the time I'm listening to macro stuff, I'm rolling my eyes thinking, this is definitely was written by some sort of economist, probably just to confuse the hell out of us. Somebody translate this for me. And then you have, Markets for Mayhem, who does a really nice job of bringing it down to the level where I think it's easy to digest. It's easier to understand what's happening, because we do need to know what's going on in the markets, I think, to be successful traders. You can't just get stuck in your own bubble forever, because you're going to get blindsided by some event that you had no idea was coming, right? So there needs to be both. And this is what I'm really excited about with Traderade, is blending the focus that we've had for the last several months, which has been strictly on trading, mostly day trading, and now being able to talk more openly about markets in a broader sense. Other markets, other methods of trading, other methods of investing. So I can't thank you enough for coming on board and partnering with me on this endeavor, because I think it's going to be a lot of fun working together and trying to provide something that hopefully provides a lot of value to other retail traders like us.
I'm really excited too, and I really appreciate that very, very kind introduction. You said so many wonderful things. I can't thank you enough. And I feel the same way about you, that we complement each other's skill sets, and you are an absolutely fantastic trader. I mean, I've seen how you built your system over time. I've seen how you built custom indicators to help facilitate greater conviction in your trading. I've seen how you've helped guide so many different people on Twitter and on tradefat.com to enhance their trading journey. And so to be able to be a part of that and to help others, and really that's why I joined Twitter in the first place. My goal is to help as many people as I can. I was fortunate enough to have some very wonderful mentors, and I want to pay it forward. I want to help as many people as I can, on Traderade, on Twitter, on YouTube. Like this is really about not just the biggest battle we face, which is us versus ourselves. It's also about the other battle we all face as traders, especially as we become more proficient. It's us versus the market. And so once we get, kind of an appreciation for where we are and where we're going and how we're going to fight those battles, we need allies. And the best kind of ally to have, and I say this from personal experience, and I've talked to countless others that have had the same kind of experience, is mentors that have more experience than us. The more that someone else can help us avoid painful mistakes and learn some of the techniques that do, that can work for trading, the better off we are as traders. And quite frankly, when we talk about the difference between trading and investing, the real difference is time span. We're all traders as investors too. Exactly. We're just using a much longer time span.
Yep. Everybody's a trader. Our hold times are just different. I've been saying that for years, So, we're going to give you guys more details to come here shortly, but we're pumped to be able to provide what we're really looking to do is provide a community and content to help guide you on your journey to learning how to navigate the markets. And one of the things I'm most excited about is kind of like what we did today, learning about what else is out there. What do other people do? Bringing exposure to different strategies to help pique your curiosity. Because, when I started seeing your charts, mine was piqued, because I do a lot of swing trading, but I don't use Ichimoku. And I've seen the charts posted by people for years. It's a very well-known strategy. And I started to think, why the heck don't I know about this? And, so just having this conversation, you walking us through at a high level, what the different lines mean, what the clouds mean, piques my interest to go dig into the math, right? To understand, how does the system actually work? How does it backtest? That kind of stuff. That's what we're looking to do, is really get other people as excited as us, excited about learning how to navigate the markets on their own, taking control of some of their own financial decisions in the marketplace, not just day trading, which is really what TradeFat has been about for a while. But I want to expand that. And that's why I think you're the perfect partner to do this with, is to help, sort of broaden our horizons to look at a longer term horizon. Because I personally, I day trade for a reason, and it might be different than other people, but I roll my profits into investments. I love making investments. I love not only swing trading, but actually buying holding things for the long term. And I think, what I'm excited about is watching this grow to be more than just day trading, but to be also focused on that swing trading, investing mindset, how to, properly hedge, protect yourself when things get dicey. Who knows what's going to happen in 2022? We strongly believe this is going to be a very strong year for traders, right? The year of the trader, as we've been jokingly call it. So we're looking forward to navigating this together as a community. That's what we want Trader Aid to be about. And we're super pumped to get started with this.
And I think that what you said there, I just want to key off that a little bit. I know there's a lot of people that are nervous out there. I know a lot of people have taken some difficult losses if they're out there in small to mid cap, tech or growth or biotech or some of these Chinese stocks or other areas. But I also want you to, if you're listening here and you're thinking about giving up hope, don't give up hope. Whether the market's going up, down, or sideways, there are ways to make money in that market. And what Horst and I are really trying to bring about is a community that can help you as an individual trader and investor survive various market conditions. If 2022 ends up being a turn into a deeper correction or a bear market, there are strategies that you can use to make money in that kind of an environment, just like you can make money in a bull market. It's just not something that most people are naturally hardwired to do because it involves having to reevaluate some of our preconceived notions about how markets work. And if you haven't experienced a real bear market, I mean something like late 2007 to early 2009, it's also important to appreciate what that means in terms of risk, in terms of opportunity cost. And we're going to be talking a lot about that because it's our view that, the new volatility regime that we're seeing, this sort of leptokurtic distribution of fat tail risk, this is a theme for 2022. Heightened volatility, larger swing potential both ways. And that is a trader's paradise. As Horst said, this is the year of the trader. If you really want to take advantage of it, come check us out. We're going to be doing some really exciting stuff, from classes to instructional content and to ideas, sharing with you what's on our screens, analysis. We're going to break it all down, and we're going to try to provide a level of value that is exceedingly competitive with every other offering out there. And we're not just going to be trying to tell you how you can get into this position and get out of that position in terms of a signal. We're going to try to teach you how to become better traders and investors so you can become more self-sufficient. We don't want to just be a signal. We want to be a beacon of information so we can raise your skill level and provide you with better tools to be a more successful trader and investor.
Absolutely. It's about teaching people to fish, and I'm not bashing on anyone's service, but, I've always struggled with those ones where it's just folks making calls, like I like Apple at 170, that doesn't really help anyone learn, in my opinion. Why do you like Apple at 170, right? What is your entry? What's your stop loss? What's your strategy for taking profits? We want to teach people to fish and have a community where we can live and grow together and sharpen our skills as traders, as specifically as retail traders, right? It's often hard to figure out how to sort through some of the noise because most of market news doesn't come from retail, right? It comes from institutions, it comes from the squawk box, so to have a way to translate that for what does this mean for retail and have an environment where we can converse together and grow is what I'm really most excited about. Creating a community, a non-toxic community. There's a lot of great stuff on Twitter, but there's also a boatload of trolls, as you know, that just drive me insane, where I want to create something that's really about positivity and trying to grow together. And that's what I'm really excited about. So I can't thank you enough for being here on this show. I know this is not the typical Horst interview, but we threw you a little curveball. I wanted to have Mayhem on because I wanted to understand his strategy more, but I'm also excited to announce this new venture together. Trader Aid is going to be coming soon this weekend. We're going to switch everything over. We'll give details for the existing members to let everyone understand how that's going to take place. But again, thank you for being here today. I look forward to many more of these discussions because I know you don't just trade Ichimoku. I want to pick your brain on some of the other strategies that you employ, specifically about options. I know you're very knowledgeable in that area. So this is the first of many. I'm excited for our partnership and our journey. Thank you so much for being here, Markets for Mayhem. Where can people find you? Where's the best place to find you? Give me your hashtag again, your Twitter handle.
Sure, yeah. Mayhem #4 Markets. Mayhem for Markets is where you can find me on Twitter. You can also find me on YouTube, youtube.com/C Markets and Mayhem. And you can also find me on my website at marketsandmayhem.com.
And now they're going to be able to find you on TraderAid, which I'm so excited about. So thank you so much for being here. Looking forward to chatting with you and posting and just getting this thing launched together and creating that community that we want to be a part of. Thanks for your time today.
Thanks for having me, Horace. I'm really excited. I'm working on this together, and I look forward to plenty more of this content to come.